Welcome to the deep dive. The stock market. A lot of us, we watch it, maybe dabble a bit, but it often feels like this big, complicated machine, right? Today, we're really going deep. Not just the what of investing, but the why. Why does it work like this? What are the big ideas behind it all? We've got a whole stack of sources here. Everything from, the nuts and bolts of making a trade to some really profound stuff from legendary investors.
Yeah, and our mission today is basically to pull out the really key insights. We want to help you connect the dots, the basic concepts, the different strategies, the lingo, without it feeling overwhelming. Think of it as like your shortcut to getting properly informed about how this whole world operates.
Okay, let's unpack this then, starting right at the beginning.
Yeah.
Common stock. We kind of know it's owning a piece of a company, but what does that actually mean for you, the investor? Especially, when things maybe aren't going so great for the company.
Right, this is crucial. It's this concept of being a residual owner. And residual really means, well, last in line.
Yeah.
As a stockholder, you're entitled to a slice of the company's earnings, maybe dividends, sure, but only after everyone else gets paid. Bondholders, suppliers, employees, they all come first.
So you get what's left over, which sounds risky.
It is riskier, absolutely. But that's the flip side, right? Because you're last in line, your potential upside isn't capped. If the company does spectacularly well, that residual amount, your slice, could be huge.
Okay. So that risk comes with potentially much bigger rewards. It's not just about maybe getting some dividend checks, which is nice, but it's also about the possibility of the stock itself becoming way more valuable over time, those capital gains. And you can kind of match that risk-reward thing to your own goals.
Exactly. Understanding that you're a residual owner, that fundamental position, that's step one. It really helps you align your investments with what you're trying to achieve financially. It's knowing the real deal of what you own.
Got it. Okay, so knowing that, how do people actually try to make money from this? The obvious way is buy low, sell high. But you're saying there's more to it.
Yeah, there are basically two main paths. The first one is what you just said, the common one. It's called a long purchase. You buy a security, it could be stock, bond, whatever, expecting the price to go up. Simple enough, buy low, sell high. That's the aim.
Okay, standard stuff. What's the other way? The less intuitive one.
That's short selling. And yeah, it feels a bit backwards at first. With short selling, you're essentially selling a security you don't actually own yet.
How does that even work?
You borrow it, usually from your broker. You borrow the stock, sell it on the market immediately, hoping the price will fall. If it does fall, you then buy the stock back at that lower price, return it to your broker, and pocket the difference. So you're aiming to sell high, buy low. It's betting against the stock.
Sell high, buy low. Definitely counterintuitive. And probably riskier, too.
Oh, significantly. We can get into that. But yeah, those are the two main directions investors bet on.
And these strategies, they don't happen in a vacuum, right? They feed into the overall market mood, the animal spirits, I guess.
That's a great way to put it. And we have terms for that mood: bull market and bear market. A bull market is when things are generally going up. Prices are rising, people feel optimistic, the economy is usually growing, maybe there's some government stimulus helping things along, bull charging ahead.
Optimism, growth.
Upwards.
Exactly. And a bear market is the opposite. Prices are falling, pessimism is widespread, the economy might be slowing down, maybe the government's tightening things up. Think of a bear swiping downwards. These aren't just labels, they really describe the environment you're operating in. Affects everything.
Okay, so you've got these big market swings, bull and bear. How do investors then pick specific stocks to buy or short? What are the approaches?
Well, there are a few common ones. One is what you might call the headline chaser. You see some news about a company, good news, maybe you buy. Bad news, maybe you think about shorting it. You can find tickers everywhere. Yahoo Finance, Bloomberg. Seems straightforward, but does it work?
It's tough. Really tough. The sources point out that you're often competing with high-frequency traders, algorithms that react in microseconds, by the time you read the headline.
The opportunity might already be gone or priced in.
Exactly. So the takeaway might be less about chasing headlines and more about asking if there's a deeper edge you can find.
Which maybe leads to someone like Peter Lynch, his whole invest in what you know idea. Sounds simple, maybe too simple.
It's simple advice, but often misunderstood. It's not just buying stock in your favorite coffee shop because you like the coffee. Lynch meant using your own experience as a consumer, or maybe in your job, to find companies that are genuinely doing something well, something you understand. You notice a great product, or maybe a really terrible one. Then you dig deeper. Why is it good? Is the company solid? That observation is just the starting point for proper research, not the end point.
So it's about using your real-world knowledge as a clue, then doing the homework.
Precisely. It's about turning that observation into actual insight before you even think about buying or, much more riskily, shorting.
Okay, another way people look for opportunities is charts, right? Looking at past prices.
Yeah, that's technical analysis.
Yeah.
It's all about studying historical price movements and trading volumes, often using charts you can find online, like stock charts or Yahoo Finance again. The idea is that patterns in past prices might hint at future movements.
Hmm.
You see an upward trend, maybe you buy. A downward trend, maybe sell or short.
But is it just about lines on a graph?
Well, technicians would say those patterns reflect market psychology. But the key, I think, is understanding why a pattern might be forming and knowing it's not foolproof. It's another tool, maybe best used alongside understanding the actual business, not instead of it.
Right. So you've decided, you've done your research, maybe looked at charts, whatever. How do you actually do the trade? It's not just hitting buy, is it? There are different prices.
Yeah, you need to understand the basics of pricing. When you look up a stock, you'll see two key prices. There's the bid price. That's the highest price any buyer out there is currently offering to pay for the stock. And then there's the ask price. That's the lowest price any seller is currently willing to accept.
And the difference between them is the spread.
Exactly. That's basically the immediate cost of trading. Now, when you go to place your order, you have choices there too.
Like market orders versus limit orders. I hear those terms a lot.
Right. A market order is simple. You're saying buy this stock or sell this stock right now at the best available price. That means you'll likely buy at the current ask price or sell at the current bid price. It's the fastest way to get your trade done. Guaranteed execution, basically.
But you don't control the exact price.
Correct. Which is where a limit order comes in. With a limit order, you set the price. You say, I only want to buy this stock if I can get it at $50 or less. Or, I only want to sell if I can get $55 or more. Your order will only go through if the market reaches your price, or does better. You get price control, but you might not get the trade done if the market moves away from your limit.
So it's speed versus price control.
That's the trade-off. And the advice here is pretty clear. Know how these work. Always, always double-check the stock ticker symbol. Typos can be expensive. And seriously, consider using limit orders, especially if the stock is volatile or doesn't trade much. Gives you that protection. Verify everything before you hit submit.
Good practical advice. Okay, so we buy some stock, but not all stocks are the same, are they? They seem to have different personalities.
That's a great way to think about it. And understanding these categories is really useful for building a portfolio that fits you. You got your blue chip stocks. These are the big, stable, well-known companies. Financially strong, leaders in their field, usually pay dividends. Think Johnson & Johnson, McDonald's. Lower risk, generally.
The household names.
Then there are income stocks. Their main appeal is dividends. They have a history of paying out higher than average dividends, maybe increasing them over time. Utility companies, some consumer goods firms like, say, Duke Energy or Conagra, good for generating current income.
Makes sense. What about growth?
That's where growth stocks come in. These companies are expanding fast sales, earnings, everything. Investors buy them, hoping for big price increases, not really for dividends, which are often small or non-existent. Think Netflix, maybe eBay back in the day, Starbucks. The focus is all on future potential.
Higher potential reward, maybe higher risk if the growth slows down.
Exactly. Then you got tech stocks. This is a huge category, obviously. It covers everything from speculative startups to giants like Microsoft or Cisco. Can offer great returns, but also lots of volatility. Innovation moves fast.
Right. And speculation brings us to speculative stocks.
Yep. These are often companies banking on something specific, a new invention, a potential buyout. They don't have a long track record. Earnings are uncertain. Think maybe SiriusXM or Under Armour in their earlier, riskier phases. Huge potential gains, but also huge potential losses. Very volatile.
Okay, what else?
Cyclical stocks. Their fortunes are tied directly to the overall economy. When the economy is booming, they do well. When it slows down, they tend to suffer. Think heavy industry, construction, materials, companies like Alcoa, Caterpillar, maybe home builders like Lennar.
So they follow the economic cycle. Makes sense.
And finally, defensive stocks. These are the opposite of cyclicals, in a way. They tend to hold up better when the economy struggles. People still need their products regardless. Think Walmart or even WD-40. Basic necessities, staple goods. Gold stocks are often seen as defensive too, a safe haven.
Wow, that's quite a range. And Peter Lynch had his own categories too, didn't he? Like stalwarts, fast growers.
He did. He added more nuance, like distinguishing between slow growers, the reliable stalwarts, the fast growers we talked about, cyclicals, turnarounds companies recovering from problems, and asset plays where the value is in the assets they own.
Yeah.
It helps you really zero in on the kind of company and opportunity you're looking at.
So many ways to slice it. And isn't there also something about company size, like caps?
Ah, yes, market capitalization or market cap. That's just the total value of all a company shares. It's another way to categorize. You have small cap, typically companies worth less than, say, $2 billion. Mid cap, maybe $2 billion to $10 billion. And large cap, everything over $10 billion. Size often correlates with risk and growth potential. Small caps can be riskier but grow faster. Large caps more stable.
Okay, so that gives us a lot of ways to think about individual stocks. What about overall strategies, like big picture philosophies?
Broadly speaking, you can think of two main camps, passive and active. The passive strategy basically says, look, trying to pick winners or time the market is really hard, maybe impossible long term.
Hmm.
So the focus is on just capturing the market's overall return, minimizing costs, and staying invested.
How do you do that?
Two main ways. One is buy and hold. Find good quality companies, buy their stock, and just hold on for the long haul.
Yeah.
Very value-oriented, conservative. The other is using index funds, or ETFs. These funds just try to replicate a market index, like the S&P 500. You're not trying to beat the market, just match it. They're typically low cost, tax efficient. It assumes markets are pretty efficient.
Okay, so that's passive. Just ride the wave. What's the alternative?
The active strategy. This is where you are trying to beat the market. It involves actively selecting specific securities you think are undervalued, maybe focusing heavily on things like earnings per share growth. It might involve trying to pick between growth and value stocks or rotating between different industry sectors based on momentum. And often it involves trying to time the market, getting in before it goes up, getting out before it goes down.
Which sounds appealing, but hard.
Incredibly hard
Mm.
and risky. One source had a stunning statistic. If you missed just the 16 best days in the market over 100 years, you'd miss something like 2/3 of the total returns.
Wow, just 16 days out of a century.
Yeah. So it really makes you ask that fundamental question. Are you realistically equipped to beat the market consistently? Or is your goal just to participate in its long-term growth? Big difference in approach.
Definitely something to think about. Now, beyond just the mechanics, some sources dive into deeper principles, sort of the wisdom of investing.
Absolutely. And these are powerful. Stephen Penman, in Accounting for Value, really grounds things. He says, one does not buy a stock, one buys a business.
Changes your whole perspective, doesn't it?
Instantly. It forces you to ask, do I actually understand this business? Not just the ticker. Then there's price is what you pay, value is what you get. A classic reminder not to confuse the two. And a really crucial one. Beware of paying too much for growth. It's easy to get excited about growth prospects, but overpaying can destroy returns. His point is that eventually prices tend to follow the underlying fundamentals, the real value. It just might take a while.
Patience again. And what about this expectation investing? Sounds intriguing.
Yeah, this comes from Rappaport and Mobysun. They frame investing as a game against other investors. Oh, wait. Your job isn't just to forecast the future. It's to figure out what future the market already expects, what's baked into the current stock price. Then you decide if you agree with those expectations. If you disagree, it's probably about the growth forecast embedded in that price. Are the market's expectations too high? Too low? That's where you might find an edge.
So it's about understanding the consensus and then deciding if you have a reason to differ.
Smart. Okay, so if we're thinking about value and expectations, is there a common tool people use to get a quick read on valuation?
A very common one, though it has its limits, is the price earnings, or PE ratio. It's pretty simple. You take the stock price and divide it by the company's earnings per share, EPS. It basically tells you how many dollars investors are willing to pay for each dollar of the company's current earnings.
And different PE ratios mean different things? Right. A high PE might suggest investors expect high future growth. A low PE might mean lower growth expectations, or maybe the market thinks the company is riskier or perhaps undervalued. It's a starting point for comparison, but you need context.
Got it. Now, something else that comes up is leverage, using borrowed money.
Margin trading.
Yes, margin trading. It's a way to potentially amplify your returns, but it's definitely a high-risk tool. Essentially, you borrow money from your broker to buy more securities than you could with just your own cash. The securities you already own act as collateral for that loan. There are rules set by the Fed about how much you can borrow the margin requirement. Like, a 50% requirement means on a $10,000 purchase, you put up $5,000, the broker lends you $5,000.
So the advantage is bigger potential profits.
Exactly. Financial leverage magnifies gains. If the stock goes up 10%, your return on your own invested capital is much higher because you controlled more stock.
But the catch is huge. Leverage magnifies losses just as much or even more so because of interest. If the stock goes down, your losses on your own capital are amplified. Plus, you're paying interest on that loan, which eats into any profits or adds to losses. And the biggest risk is the margin call.
What's that? Sound ominous.
It is. If the value of your stocks, your collateral, falls too low, your broker will demand you deposit more cash or sell securities to bring your equity back up to the required level. If you can't meet the margin call, they can forcibly sell your positions, often at the worst possible time to cover the loan.
Yikes. So, powerful tool, but handle with extreme care. Or maybe not at all for most people.
Definitely needs serious consideration and understanding of the risks.
Okay, bringing it all together. After all these strategies, tools, risks, what's the general wisdom, the parting advice from these sources?
It often boils down to discipline and mindset, honestly. The kind of things that sound simple but are hard to do. First, don't get carried away. Stick to your strategy, whatever it is. Don't just trade constantly that's churning. And be very careful with margin, maybe avoid it altogether.
Stay grounded. Makes sense.
Second, don't be afraid to sell a loser. Holding on, hoping it'll come back can be devastating. Cut your losses sometimes.
Emotionally hard, but rational.
Third, don't chase performance. Buying what just went up often means you're late to the party. Fourth, be humble. Be open-minded. The market will humble you eventually anyway. Be ready to admit mistakes and learn.
Good life advice, too, probably.
Probably. Fifth, review your investments periodically. Do they still make sense? Do they align with your goals? And finally, maybe summing it all up. Don't trade too much. Often, less is more. Patience, discipline. These themes come up again and again.
Seems like controlling your own emotions and behavior is maybe just as important as picking the right stock.
Many would argue it's more important.
Wow. Okay, that was genuinely a deep dive. We've gone from the absolute basics of what a stock is, being that residual owner, all the way through long and short strategies, bull and bear markets, different types of stocks, passive versus active investing, margin risks, and some really core principles.
Yeah, we've covered a lot of ground, from understanding you own a piece of a business to how market psychology plays out, the different personalities of stocks, and that crucial advice about discipline and not overpaying.
So for you listening, what does this all mean? Hopefully, you now have a much richer understanding of the language, the mechanics, the why behind the stock market, whether you're thinking about long-term wealth building, maybe more active trading, or even just trying to make sense of the financial news without getting, swept up in the daily hype.
And stepping back, thinking bigger picture. The market isn't just numbers flashing on a screen. It reflects real businesses, human psychology, how information flows or doesn't flow, which leads to maybe a final thought, a question for you to ponder. Given all this market swings, different stock types, the gap between price and real value, how does your understanding of a specific company's actual business change how you view its stock price, especially when the headlines are screaming one way or the other?
How much does the business reality matter versus the market noise? Definitely something to think about. Thanks for joining us on this deep dive.